The world of mutual funds isn't just about growth, income, or diversification. It's also about timing, taxes, and knowing which type of share fits the person investing. Each mutual fund share represents ownership in a portfolio of securities managed by professionals. But how those shares behave, how they're taxed, and how their costs unfold over time, that's where most investors and most exam questions find their challenge. Let's start with how mutual fund income is taxed. A fund can earn three types of income: interest, dividends, and capital gains. Interest income comes from the bonds the fund holds. It's taxed to investors as ordinary income in the year it's received. Dividend income comes from the stocks in the portfolio. That's also taxed when it's distributed, though qualified dividends are usually taxed at the lower capital gains rate. Capital gains arise when the fund sells securities for more than it paid. Each year, mutual funds must distribute at least 90% of their net investment income, that's the interest and dividend income, minus expenses, if they want to avoid paying corporate income tax. That rule comes from Subchapter M of the Tax Code. Funds that meet it are called regulated investment companies. When a fund qualifies, it acts as a pass-through, meaning the shareholders, not the fund itself, pay the taxes on income and gains. So while the fund calculates and reports its results, the investor bears the tax liability. Distributions come in two forms. Income distributions are the regular payments of interest and dividends, typically made monthly or quarterly. Capital gain distributions are made at least once per year, and they represent realized gains from the fund's trading activity. For investors, here's the key distinction. When a mutual fund distributes a gain, it doesn't matter whether the investor reinvests it or takes it in cash. Either way, it's taxable in the year it's paid. And that's true even if the investor bought into the fund just before the record date. Short-term gains, profits on securities the fund held for 1 year or less, are taxed as ordinary income. Long-term gains, profits on securities held more than 1 year, are taxed at the long-term capital gains rate. If the fund loses money selling its holdings, those losses can offset gains inside the fund, but not in the investor's personal return. The tax consequences appear only at the shareholder level, through the distributions received and the gains or losses when shares are sold or redeemed. When a shareholder redeems shares, they calculate a gain or loss based on cost basis, what they paid, versus the amount they receive. If the shares were held for 1 year or less, the gain or loss is short-term. If longer than 1 year, it's long-term. Now let's talk about how investors pay for the privilege of owning mutual funds. Funds charge management fees to cover the cost of professional management. They also charge expenses for administration, marketing, and distribution. The total of these is known as the expense ratio, total expenses divided by average net assets. Sales charges are another matter. They're how brokers are compensated, and they appear in several forms depending on the share class. Class A shares charge a front-end sales load. That means part of the investor's money goes to sales charges up front, and the rest is invested. Over time, Class A shares tend to have the lowest ongoing costs, making them suitable for long-term investors or those investing large amounts. Class B shares don't charge a front-end load. Instead, they impose a contingent deferred sales charge, a back-end fee that declines the longer the shares are held, eventually reaching zero after several years. Once that period ends, B shares often convert automatically into Class A shares, which carry lower annual expenses. These are often best suited for investors with moderate time horizons, long enough to let the back-end charge decline, but not so long that they'd be better off with the lower expense ratio of A shares. Class C shares usually carry a level load, a small, ongoing annual charge, plus perhaps a 1-year back-end fee if sold early. They don't convert and tend to remain more expensive if held for many years. They're designed for short-term investors who expect to move in and out within a few years. For the exam, remember this pattern. Class A, front-end load, lowest annual expenses, long-term suitability. Class B, back-end load, converts to A later, medium-term suitability. Class C, level load, no conversion, short-term suitability. Some mutual funds waive sales charges altogether for certain investors, retirement plans, reinvested dividends, or through breakpoints and letters of intent. Breakpoints are volume discounts. The more you invest, the lower the sales charge percentage. Letters of intent allow an investor to sign a document committing to invest enough over 13 months to reach a breakpoint, and they receive the reduced sales charge immediately. Rights of accumulation let investors use the current value of existing holdings plus new purchases to qualify for reduced sales charges in the future. For exam questions, it's essential to remember that breakpoints are available only within the same fund family and only for related accounts. Attempts to split purchases across multiple fund families to avoid hitting a breakpoint, that's called breakpoint sales, are prohibited. Now let's connect this to taxation again, because mutual fund investors face two timelines: the fund's distributions and their own sales. Distributions are taxable in the year they're received or reinvested. When shares are sold, any gain or loss is based on the difference between redemption price and cost basis. If the investor has been reinvesting dividends and gains over time, the cost basis includes all those reinvested amounts. That's what keeps the math fair. Otherwise, investors would be taxed twice on the same income. Suitability is the human side of all this. A young investor saving for retirement, comfortable with market swings, might choose growth funds or aggressive equity funds. Someone seeking steady income might favor bond funds or balance funds. An investor who needs liquidity and preservation of capital could lean toward money market funds. Each share class adds another layer of suitability. Large, long-term investors benefit from Class A shares and breakpoint discounts. Moderate investors with medium horizons may consider B shares. Short-term investors, or those who trade more frequently, may prefer C shares, though they'll pay higher annual expenses. And of course, for accounts like IRAs or 401ks, where taxes are deferred, the choice of share class focuses on cost efficiency rather than tax timing. In the end, mutual funds represent one of the simplest, most flexible tools in the markets, yet beneath that simplicity are layers of structure, cost, and tax treatment. Understanding them isn't about memorizing rules. It's about seeing how they fit together, how a fund's expenses affect its yield, how its distributions affect taxes, and how its share class affects the investor's outcome. Because the more clearly you see that structure, the more clearly you can match the right fund to the right person, and the better you understand the quiet efficiency of pooled investment itself.